You know what's wild? Last month, you checked your savings account and saw you earned $3.47 in interest. $3.47 on $10,000. You could barely buy a coffee with that. But here's the thing. 2 years ago, that same account was paying you maybe $150 a month. Same money, same bank, different world. And now you're sitting there wondering, should I pull my money out? Should I lock it in? Should I just wait? Look, if you've ever felt completely paralyzed by financial news about the Federal Reserve raising or cutting rates, not knowing whether to invest, save, or just hide your money under your mattress, this video is for you. Because what I'm about to show you isn't just theory. This is about your actual money right now and the invisible force that's either working for you or quietly destroying your wealth while you sleep. My name is Max from Finance with Max, and I spend way too much time thinking about what I can do to invest my money. Seriously, it's borderline unhealthy. My friends think I'm weird because I get excited about Federal Reserve meeting minutes. But you know what? That obsession has helped me understand something that most people completely miss about how money actually works in the real economy. If you're someone who's tired of getting to the end of the month with no money left, or you're frustrated watching your savings lose value while experts give confusing advice, make sure you subscribe and hit that like button if this video helps you. I promise you, by the end of this, you'll understand interest rates better than 95% of people out there. Here's the deal. Most people think interest rates are this boring, complicated thing that only matters to economists and Wall Street types. And that's exactly the misconception that keeps regular people poor. Let me show you what I mean with real numbers. Let's say you have $20,000 saved up. Nothing crazy, just a decent emergency fund. When the Federal Reserve had rates near 0% back in 2020 and 2021, your high-yield savings account was probably paying you around 0.5% annually. That's $100 a year, less than $10 a month. Fast forward to late 2023, early 2024, when the Fed raised rates to over 5%, and suddenly that same $20,000 was earning you 4.5% to 5% in a high-yield savings account. That's $900 to $1,000 per year. That's real money. That's groceries. That's a car payment. Now here's where it gets really interesting, and this is what most people don't realize. When rates were low, you were losing money even though your account balance was going up. How? Inflation. In 2021, inflation hit 7% in the United States. If your money was earning 0.5%, you were actually losing 6.5% of your purchasing power every single year. Think about that. Your $20,000 could buy you $20,000 worth of stuff in January. By December, it could only buy you $18,700 worth of stuff. You lost $1,300 in real purchasing power, and your bank statement made it look like you were earning money. This is the invisible wealth transfer that happens when you don't understand interest rates. Okay, so let's break down what's actually happening here. The Federal Reserve, which is basically the central bank for the United States, but similar institutions exist everywhere in the world. The European Central Bank, the Bank of England, the Bank of Japan, they all do the same basic thing. They control something called the federal funds rate in the US, or the policy rate in other countries. This is the interest rate that banks charge each other for overnight loans. Now, you might be thinking, Max, why should I care what banks charge each other? Here's why. That rate is the foundation for every other interest rate in the economy. Your mortgage rate? Based on it. Your car loan? Based on it. Your credit card APR? Based on it. The interest your savings account pays? Based on it. The returns you can get from bonds? Based on it. When the Federal Reserve raises rates, they're essentially making money more expensive to borrow. And when they lower rates, they're making money cheaper to borrow. Let me give you a concrete example. In March 2022, the Federal Reserve's rate was 0.25%. A 30-year mortgage in the United States averaged around 3.5%. Your credit card might have charged you 16%. By July 2023, the Fed had raised rates to 5.25%. That same 30-year mortgage, now averaging 7%. Your credit card,
now charging you 21%. Same person, same creditworthiness, but the cost of borrowing money basically doubled in 16 months. Now here's the psychological shift that happens, and this is crucial. When borrowing gets expensive, people stop buying houses, they stop buying cars, they stop expanding their businesses. The economy slows down. And that's exactly what the Fed wants when inflation is running hot. See, here's what most people don't understand about inflation. Inflation happens when too much money is chasing too few goods. During COVID, governments around the world printed massive amounts of money. Stimulus checks, business loans, unemployment benefits, all that money hit the economy at once. Meanwhile, factories were shut down, supply chains were broken, and there weren't enough goods to buy. Result? Prices exploded. The Federal Reserve's job is to cool that down. How? By making money expensive. When money is expensive to borrow, people borrow less. When people borrow less, they spend less. When they spend less, businesses lower prices to attract customers. Inflation comes down. But here's the catch, and this is where it affects your money directly. Everything happens with a lag. The Fed raises rates today, but it takes 12 to 18 months for the full effect to hit the economy.
Let's talk about what this means if you're a saver. And look, I'm going to be real with you here. If you kept your money in a traditional savings account at a big bank during the rate hike cycle, you got screwed. A study by Bankrate in 2023 found that the average savings account at major banks was still paying just 0.4% interest, even though the Federal Reserve had raised rates to over 5%. Meanwhile, online high-yield savings accounts were paying 4.5% to 5%. Same FDIC insurance, same safety, but one was paying you 10 times more. Let me show you what this means with actual numbers. You have $50,000 saved. Your big bank is paying you 0.4%. That's $200 a year. After taxes, maybe $160. You move that money to a high-yield savings account paying 5%. That's $2,500 a year. After taxes, around $2,000. By staying lazy and not moving your money, you just gave up $1,840 per year. Over 10 years, that's $18,400 you left on the table for doing nothing, for not making one simple transfer. Now, maybe you're thinking, but Max, rates are gonna come down eventually. Why bother moving it now? Here's why. Because every month you wait is money you're never getting back. Time is the one thing you can't recover in finance. If you wait 6 months to move your money, you've already lost $750 to $900. That's gone forever. This is what I mean about the psychology of money. People get paralyzed by trying to time things perfectly instead of just doing the obvious smart thing right now. But here's where it gets even more interesting. When the Federal Reserve starts cutting rates, which many economists expect will happen gradually, your high-yield savings account rates will drop. That 5% will become 4.5%, then 4%, then 3.5%. And this is where most savers make their second big mistake. They panic and do nothing, or they move all their money into long-term bonds or CDs right at the worst time. Okay, let's flip this. What if you're an investor? What if you're putting money into stocks, bonds, real estate? Here's the brutal truth. Interest rates are the single most important factor in asset prices. Not company earnings, not economic growth, interest rates. Why? Because of something called the discount rate. Stay with me here, this is crucial. Every investment is worth the sum of all its future cash flows, discounted back to today. When interest rates are low, future cash flows are worth more today. When interest rates are high, future cash flows are worth less today. Concrete example, a tech stock that's expected to earn $10 per share in 10 years. When interest rates are at 2%, that future $10 might be worth $8.20 today. But when interest rates rise to 5%, that same future $10 is only worth $6.14 today. Same company, same earnings, but the stock price drops by 25% just because interest rates went up.
This is why the S&P 500 dropped 18% in 2022 when the Fed started raising rates aggressively. It wasn't because companies were doing badly. Most companies were reporting record profits. It was purely because higher interest rates made those future profits less valuable today. Now here's where the real opportunity comes in, and this is what separates people who build wealth from people who just survive: understanding the cycle. When rates are high, like they were in 2023 and early 2024, bonds become incredibly attractive. You could buy U.S. Treasury bonds paying 5% with basically zero risk. That's guaranteed money. For context, from 2010 to 2020, those same bonds were paying 1.5% to 2.5%. But here's the thing: bond prices move inverse to interest rates. When rates go up, bond prices go down. When rates go down, bond prices go up. So if you bought a 10-year Treasury bond in late 2023 yielding 5%, and then the Fed cuts rates down to 3% over the next 2 years, your bond is now paying way more than new bonds. Other investors will pay you a premium for it. You could sell that bond for $1,150 to $1,200, even though you only paid $1,000. You locked in high interest, and you get capital appreciation. This is the game that sophisticated investors play. They don't just react to rate changes, they anticipate them and position themselves to profit. Same thing with stocks. When rates are high, growth stocks get destroyed because all their value is in distant future earnings. But when the Fed starts cutting rates, those same stocks explode higher because future earnings become more valuable. Look at what happened in late 2023 and early 2024. The market started pricing in Fed rate cuts. The Nasdaq, which is heavy with tech and growth stocks, rallied over 40% in just a few months. Not because earnings improved dramatically, because investors anticipated lower interest rates making those stocks more valuable.
Now let's talk about real estate, because this is where interest rates hit people the hardest. A $400,000 house with a 3.5% mortgage costs you about $1,796 per month in principal and interest for a 30-year loan. That same $400,000 house with a 7% mortgage, $2,661 per month. That's an extra $865 per month. Over 30 years, you're paying an additional $311,000 in interest. $311,000. This is why housing markets froze in 2023 and 2024. People who bought or refinanced in 2020 and 2021 were sitting on 3% mortgages. Moving to a new house meant giving up that low rate and taking on a 7% rate. Even if they got a better house, their monthly payment could double. So what happened? People just stopped moving. Housing inventory collapsed. Prices stayed high because there was no supply. But here's the opportunity most people missed. If you had cash or access to capital during this period, you could negotiate incredible deals. Motivated sellers who had to move were willing to offer seller financing at below market rates or drop their price by $50,000 to $100,000 just to get the deal done. When everyone is scared, that's when opportunities appear. And here's what's going to happen when rates come down. Everyone who is sitting on the sidelines waiting for lower rates will rush back into the market at once. Demand will spike, prices will rise, and the people who waited to save money on interest will end up paying way more for the house itself. This is the paradox of timing the market. By trying to optimize one variable, you often make another variable worse. All right, here's what you actually need to do with this information right now. First, if you have money in a savings account at a traditional bank, stop what you're doing after this video and open a high-yield savings account. It takes 15 minutes. No excuses. Every day you wait costs you money. Second, if you have high-interest debt, credit cards charging you 20 to 25%, that needs to be your absolute priority. When rates are high, debt gets even more expensive. The Federal Reserve raising rates means your credit card company's making even more money off you. Kill that debt aggressively. Third, if you're investing for the long term, 10 years or more, do not try to time interest rate cycles. Keep investing consistently.
dollar cost average. When rates are high and markets are down, you're buying assets on sale. When rates come down and markets rally, those discounted assets appreciate. Fourth, consider building a bond ladder. Buy bonds with different maturity dates, some short-term, some medium-term, some long-term. As each bond matures, you can reinvest at whatever rate environment exists then. You're not betting everything on rates going up or down. Fifth, understand that interest rates affect different assets differently. When rates are high, value stocks and dividend stocks do better than growth stocks. When rates are low, growth stocks outperform. Adjust your portfolio accordingly based on where we are in the cycle. And here's the most important thing. Stop being passive with your money. The people who build real wealth aren't smarter than you. They're not luckier than you. They just pay attention and take action when opportunities appear. The Federal Reserve's interest rate decisions are creating massive transfers of wealth every single day. You can either be on the receiving end of that transfer, or you can be the one losing money while other people get rich. The choice is yours. The information is out there. You now understand how this works better than most people. So what are you going to do about it? If this video helped you understand interest rates and how they affect your money, hit that like button and subscribe. Drop a comment below telling me what action you're going to take first. Your future self will thank you.